Hello friends, welcome back to another important lecture. Now, since your Advanced Business and Financial Management paper of CAIIB is due within next few days, I am releasing this very important lecture on financial leverage, operating leverage and combined leverage, from which every year 2-3 direct questions and very easy questions are coming. These are solid questions and play a very important role in picking some important but easy questions from your paper. So please pay attention to this lecture since we will first cover the theory and then we will do a detailed case study that will make all the concepts crystal clear for you. Also, you will understand how the questions can be formed in your examination. Now, before moving on to the lecture, one hurdle that every CAIIB aspirant faces is completing the bulky syllabus. Time is less but syllabus is huge. So to counter this issue, I have prepared these secret sauce notes, which are in fact summarized notes of all the 4 papers of CAIIB. With these notes, you can eliminate your bulky textbooks altogether. These notes, along with my question banks, have proved to be the game changer for many CAIIB aspirants. All the links to get these notes are there in description of this video, so don't miss to get these notes for enhancing your passing probability. So let's start with today's lecture. First of all, please note the term leverage simply means influence or power. In finance, leverage tells us how one financial variable affects another. Like how a small change in sales can create a big change in profits. Yes, you heard that correct. Small changes in one place creating big impacts elsewhere. Let's look at some of the financial variables where leverage usually applies. Friends, the concept of leverage generally applies to cost, sales revenue, output, EBIT or even EPS, that is earnings per share. Next, let's move to the most important part, that is the formula. Now, leverage is simply calculated as percentage change in variable Y divided by percentage change in variable X. In simpler words, as you can see, the leverage tells what's the impact of one variable, say earnings, when another variable like sales changes. This helps us to understand how sensitive our profits are to changes in inputs like sales or cost. So friends, whenever you see a leverage number, if it's more than 1, then it means there's a magnifying effect. On the other hand, if it's less than 1, then the effect is dampening. Next, why leverage is important? Now, this is because leverage shows us the risk and reward relationship in the business. It helps managers, analysts, and bankers like us make smarter decisions. And that's the basic meaning of leverage. Next, friends, there are 3 types of leverages used in financial analysis. First is operating leverage. Now, it is the relationship between sales and EBIT. Also, it helps us to understand the extent of business risk a company is exposed to. Then, second type of leverage is financial leverage. This refers to the relationship between EBIT and EPS. It in fact indicates the level of financial risk taken by the company. And finally, the third type of leverage is combined leverage. And this is the relationship between sales and EPS. This captures the overall or total risk, which includes both business risk and financial risk. Then next, friends, you all must remember this profitability chart of any company. This chart is very important and will help you in solving numericals or questions very fast. Though this chart might be looking a bit intimidating at first, but it's very easy to recall, and this chart will make you remember less formulas if you learn the application of this chart. Don't worry, you will learn the application once we solve the case study at the end of this lecture. Now please note, this portion of the chart helps us in calculating the operating leverage. Then this portion of the chart helps in calculating the financial leverage, and finally this complete portion helps us in calculating the combined leverage or total leverage. Next, let's understand each of these 3 leverages one by one. So what is operating leverage? Friends, operating leverage means the tendency of EBIT, that is earnings before interest and tax, to change disproportionately with a change in sales volume. Now this disproportionate effect happens because of fixed operating costs which stay the same regardless of how much you sell. In simpler terms, operating leverage is simply the impact of fixed cost on operating income. Now friends, operating leverage may also be defined as the employment of an asset with a fixed cost so that enough revenue can be generated to cover all the fixed and variable cost. So the key idea here is if a firm uses fixed cost asset, any increase in sales boosts profits more than proportionately. So I hope this is clear to you. Please note the use of such fixed cost assets like machinery or staff salary leads to operating leverage. Next, let's see what factors affect operating leverage. Friends, operating leverage is influenced by three things. First is the amount of fixed cost. Now, the higher the fixed cost, higher will be leverage. Then second is the variable contribution margin. Now, this is the excess of sales over variable cost. And finally, the third is the volume of sales. Now here more units sold means more the fixed cost gets spread and higher the leverage effect. Next friends, let's talk about how we measure the extent of this leverage. So when we try to quantify how much EBIT changes with a change in sales, we use a concept called degree of operating leverage. Now, degree of operating leverage is defined as the percentage change in EBIT divided by the percentage change in sales quantity. This tells us how sensitive EBIT is to changes in sales volume. So as shown here, we calculate degree of operating leverage as that is percentage change in EBIT divided by percentage change in sales, or in mathematical terms as delta EBIT divided by EBIT divided by delta Q divided by Q. So here delta EBIT is the change in EBIT, EBIT is the initial EBIT and delta Q is the change in sales quantity while Q is the initial sales quantity. Now you can also use a more simplified version of this formula, that is degree of operating leverage equals contribution divided by contribution minus fixed cost, or even contribution divided by EBIT. Now friends, I am not showing here the derivation of all these formulas because it is not of use for your examination at this level. So please remember all these formulas since question and examination can come in any form. Next, let's discuss a very useful risk analysis tool in cost accounting. That is the margin of safety, also known in short as MOS, and its relationship with operating leverage. Now friends, in cost accounting, margin of safety helps us understand how much actual sales can drop before the business reaches the break-even point. In fact, it shows the safety cushion a business has. That is how far it is from a loss situation. Now, margin of safety is simply calculated using the formula that is sales minus break-even point sales divided by sales multiplied by 100. So here sales is the actual sales. BP sales means the break-even sales. Now friends, please remember a higher margin of safety indicates first lower business risk and higher profit stability, while a lower margin of safety means higher business risk and higher chances of incurring loss if sales drop. Next one, there is also an alternate margin of safety formula which is using contribution. So margin of safety can also be expressed in terms of contribution and fixed cost. So margin of safety here equals contribution minus fixed cost divided by contribution, which is also equals to EBIT divided by contribution. So here contribution is sales minus variable cost, fixed cost is the cost that remains unchanged regardless of sales, and finally EBIT is the operating profit. Now friends, let's link this to operating leverage. Now as we have seen earlier, we know that degree of operating leverage equals contribution divided by EBIT. This tells us the degree of operating leverage depends on how big the fixed costs are compared to profits. Now comparing both these ideas, we can arrive at degree of operating leverage equals 1 divided by margin of safety. I hope this is clear to you friends. And this is also a very important relationship which is important for your examination. Now please note, margin of safety is not there in your textbooks. Now this inverse relationship helps manager decide whether they are operating in a risky zone or a safe zone. Next, let's understand the concept of financial leverage and how it's measured using the degree of financial leverage. So friends, financial leverage refers to the use of funds with a fixed cost in order to increase earnings per share. In simple terms, a company uses funds like debt, which comes with a fixed cost, that is interest, to boost the earnings for shareholders. Now, this is done with the hope that return from using these funds exceed their cost, thereby benefiting the shareholders. Next, the formula for financial leverage is simply earnings before interest and tax, that is EBIT, divided by earning before tax, that is EBT. Now, as you know, EBIT equals sales minus variable cost plus fixed cost. Please note this is the profit before paying any interest or taxes. Next, EBT is equals to EBIT minus interest. And this is the profit after paying interest but before tax. So higher the interest burden, greater the difference between EBIT and EBT and higher the leverage. Next friends, degree of financial leverage measures how sensitive EPS is to change in EBIT. And it is the ratio of percentage change in EPS divided by percentage change in EBIT. Or mathematically, it is simply delta EPS divided by EPS and whole of this divided by delta EBIT divided by EBIT, where delta EPS is change in earnings per share and delta EBIT is change in EBIT. Friends, this formula helps assess how a change in operating profit affects shareholder returns. Next, let's understand the third type of leverage, which is combined leverage and is also known as total leverage. So friends, the combined leverage is defined as the potential use of fixed cost, both operating and financial, which magnifies the effect of sales volume change on the earnings per share of the firm. In simple terms, it shows how sensitive the EPS is to change in sales when a firm uses both operating cost and fixed financial cost. So what does it combine? Friends, as we saw earlier, that combined leverage combines first is operating leverage from the fixed operating cost and second is financial leverage from the fixed financial cost like interest. So when both are present, even a small change in sales can lead to a large change in EPS. Now the formula for combined leverage is simply combined leverage equals operating leverage multiplied by financial leverage. Now substituting the formulas of operating leverage and financial leverage, we get combined leverage as C divided by EBIT multiplied by EBIT divided by EBT, where C is the contribution, that is sales minus variable cost, while EBIT is the earnings before interest and tax, and EBT is simply earnings before tax. Now, if we simplify this equation, we get combined leverage equals contribution divided by EBT. Now friends, some alternate relations to find combined leverage are, that is degree of total or combined leverage equals percentage change in EBT divided by percentage change in sales. Or also degree of combined leverage equals percentage change in EPS divided by percentage change in sales. You can use any of these formulas. So friends, if the combined leverage is high, the firm's EPS is highly sensitive to changes in sales volume. Now this can be very profitable in good times but very risky in downturns. So it's an important measure for risk assessment and financial planning. Friends, with this, I hope the theory part of leverage is clear to you and all the three types of leverages, that is operating leverage, financial leverage and combined leverage, are crystal clear to you. But as said, in examination, you will be tested with application-based questions from this chapter. So let's solve a case study that will clear all your doubts. And the case study goes like this. Novachem Industries Limited, a mid-sized chemical manufacturing firm, produces and sells 10,000 drums of industrial solvent annually. Each drum is sold at Rs 500 and variable cost per drum is Rs 200. The company incurs fixed operating cost of Rs 25 lakhs every year to maintain its plants and administrative functions. To expand operations, the company has also taken a loan of Rs 7 lakhs at 10% interest per annum. The financial team is analyzing how the firm's fixed cost structure and financial obligations impact its profitability and risk. Now answer next 4 questions based on the information given. And the first question is, the operating leverage of Novacom Industries based on the given data is, and these options are given to you. Now friends, I hope you all remember the basic formula of operating leverage, which is contribution divided by EBIT. And as I have requested earlier, please recall this table. And we have also seen that this part of table gives the operating leverage. So contribution can be found by simply deducting the variable cost from sales. Now sales can be found as 10,000 multiplied by 500 equals rupees 50 lakhs. While variable cost will be simply 10,000 multiplied by 200 equals 20 lakhs. This is because variable cost is given per drum as rupees 200 and there are 10,000 drums. I hope this is clear to you. So contribution will be simply rupees 50 lakhs minus 20 lakhs equals rupees 30 lakhs. And fixed cost is given in the case study as rupees 25 lakhs annually. So EBIT will be simply 30 lakhs minus 25 lakhs equals rupees 5 lakhs. Now, so just substitute all these values in the formula of operating leverage. We get contribution divided by EBIT equals rupees 30 lakhs divided by rupees 5 lakhs equals 6 times. So the correct option for the given question is option A. Then next question is, if sales increase by 10%, then the percentage impact on EBIT using the operating leverage is, and these options are given to you. Now friends, we have learned in the theory part that degree of operating leverage is equal to delta EBIT divided by EBIT and whole of this divided by delta Q divided by Q. So here we have to find delta EBIT. While EBIT we have already calculated in the first question as rupees 5 lakhs and delta Q, that is change in sales, is given as 10%. So delta Q will be simply 10% of rupees 50 lakhs equals rupees 5 lakhs. While Q is given in the question as rupees 50 lakhs. And also operating leverage we have found in previous question as 6. So just plug in all these values in the formula. We get 6 equals delta EBIT divided by rupees 5 lakhs and whole of this divided by rupees 5 lakhs divided by 50 lakhs. So delta EBIT will be simply rupees 3 lakhs divided by 5 lakhs is equals to 60%. So as far as this question goes, the correct option is option B. Then third question is, using the interest data from the loan, what is the financial leverage of the company? And these options are given to you. Now friends, financial leverage is calculated as EBIT divided by EBT. And we have already calculated EBIT in the first question of the case study. So now just look at this table again. You will find EBIT by simply deducting interest from EBIT. And it's also given in the case that to expand operations, the company has taken a loan of rupees 7 lakhs at 10% interest per annum. So interest cost will be simply 10% of rupees 7 lakhs equals rupees 70,000. So EBT will be simply 5 lakhs minus 70,000 equals rupees 4 lakhs 30,000. And financial leverage will be simply EBIT divided by EBT equals 5 lakhs divided by 4 lakhs 30,000 equals 1.6 approximately. Thus the correct option for the given question is option D. Friends, finally we have reached the last question of our case study, and the question is, based on your results in question 1 and question 2, what is combined leverage? And these options are given to you. Now friends, this is a very simple question. We have already calculated operating leverage and financial leverage. And we know that combined leverage is simply multiplication of both these. So combined leverage will be operating leverage multiplied by financial leverage equals 6 multiplied by 1.16 equals 6.96. Now another way to find combined leverage is simply contribution divided by EBT, which is equals to 30 lakhs divided by rupees 4 lakhs 30,000 equals 6.98. Thus the correct option for the given question is option A. So friends, I hope the case study is clear to you and all the formulas and concepts discussed in this lecture are crystal clear to you. So with this, I wind up this lecture. Don't forget to get your CAIIB resources from the links given in description of this video. So thank you.